It's been a tumultuous year for the world's biggest energy companies, with oil prices gaining and then dipping once again this week. But the hope is that the dark days are finally over for the industry. But there's still a long way to go, and with OPEC continuing to rattle the markets, well, the oil markets, what's in store for these energy majors? Well, I've got just the person to ask. Ross Mould here from AJ Bell. Hello to you.
Katie.
Wow, I mean, I said it's been a tough year, but it's been a tough, 5 years, should we say?
Well, it has. I mean, share price-wise, actually, you wouldn't guess that this year's been a tricky year, because BP and Shell are actually trading at pretty much the highest point they have all year, looking at it from a UK perspective. So in that respect, it's not been quite so tough. But yeah, in terms of the oil price going from $110 a barrel to 28 and back to 50, it's been a very wild few years, very definitely.
What is your concern going forward?
About oil, it's whether OPEC can actually get its act together or not. I mean, in the end, well, we know that they've got a dreadful record of A, not agreeing, and B, when they agree, not sticking to it. So there are clearly very high hopes after the Algiers conference we had in September, October, that will lead to an agreement at Vienna in November. Now, the Iraqis, the Iranians, the Nigerians have already said, nah, not really so sure. The Russians, non-OPEC, aren't playing. And it's interesting, what really intrigues me is what the Saudis will do. Because all the time this was going, these discussions were going on, the Saudis actually cranked up their production to record levels. So, OK, so what's really interesting is, don't forget, just last week, who issued a massive bond? $17.5 billion, the Saudi Arabians. Now, would it just be a coincidence if they were to lose interest in the oil price being quite so strong? Now they've got the bond away, because in the end, the higher the oil price, the less they need to borrow, the better the terms they get. So maybe I'm being a little bit cynical, but let's just see whether the Saudis are really, really interested in an agreement now they've got that bond issue done.
OK. I think everyone's a bit cynical when you talk about Saudi Arabia and oil, though. I think we're all guilty of that. Let's talk about these stocks, though, because we've got a whole plethora of them coming out. Chevron, Total, Exxon, Eni, they're all on the way this week. We've got BP next week. We've got Shell next week as well. Where should we start here?
Well, I think the themes, doesn't matter whether they're Italian, French, American, or British or Anglo-Dutch, the themes are all going to be the same. Cost-cutting, focus on cash flow, disposals, certainly looking at Shell, they're still looking to bolster their balance sheet. And in the end, the dividend yields. That's the real attraction for these companies. Yes, their earnings can grow very quickly if oil goes up very quickly, but I think what's more interesting to people is the yield angle they've got here, because BP and Shell, even at these levels they're at now, are still offering yields of 6, 7, 7.5%. And the higher the oil price goes, the safer those dividend yields are, because the higher their dividend cover goes.
It's actually quite impressive that they've managed to keep that up for so long, considering the tumultuous situation that the market's been in.
I mean, BP has cut its dividend twice in the last 20 or 30 years, 1991, and then after the Deepwater Horizon accident in 2010-11, it cut the dividend. Shell hasn't cut its dividend since at least 1945. So any decision with a dividend is not going to be taken lightly at that company in particular. Dividend cover of 0.5 times this year, 1 times next year, is a lot lower than you want it to be. Let's not make any bones about it, and that's why some people are sceptical. And if you look at the big equity income funds, lots of them don't have BP or Shell in their top 10, even though they've got really fat yields. So they're clearly frightened the dividends are at risk of a cut. Now, they have to cut costs, they have to cut capex. Shell is looking to dispose of assets, BP a little bit, or they can take on debt. Now, nobody wants to see a company take on debt for too long to pay the dividends, because it weakens the balance sheet, it potentially weakens the company's ability to invest in the future. But in the short term, they can probably burgle their way through for a year or two just using debt. So I think those dividends are probably safer than people think in the short term, and the higher the oil price goes, the more money they earn, the better their cash flow, the safer those divvies become.
And just going back to oil as well, we've obviously seen it dip. We mentioned the OPEC situation earlier. But in terms of production and going forward, will the oil industry ever go back to the heyday production that we had somewhat 5 years ago?
Well, price-wise, I mean, you can never say never. It got to 147 in 2007, it got to 110 in 2013, so you can never say never. I think what you need to look at in the short term, yes, look at OPEC. Yes, look at the capital expenditure plans that these companies have got. And I think Wood Mackenzie have talked about $1 trillion worth of projects being postponed out to 2020. So that's a lot of potential supply knocked off. And then I think you also can look at other things that are available for free, so it's dead easy to track them. You can look at the weekly US oil inventories that are available from the Energy Information Administration. They've come down 8 weeks in 12. And you can look at the Baker Hughes rig count, both for the US and internationally. That is the number of active pieces of equipment out in the sea or on land drilling. And those numbers collapsed. They both went down by about 60% from peak to trough. They have, however, started to go back up again. They're about 20% from their lows. So what the market won't want to see is too much of that increase. Now, the challenge here, of course, then is what do the non-OPEC people do, like the Russians and the shale drillers. They've been funded largely by debt, by the junk bond market. The lower interest rates stay, the higher oil prices go, the easier it is for the shale drillers to refinance, keep going and keep pumping. And the concern is, as soon as oil hits 50, they're back up like a jack in a box, raising money and drilling again, because that's the level at which it's economic for them to do so. So that is a potential cap.
And then we have the cyclical problem once again then.
Well, oil demand looks to be relatively price inelastic. Volumes don't seem to change that much, whether it's $110 or $30 a barrel. It's supply that seems to be the really big driver, and that's why, it's down to OPEC, inventories and rigs as the three things to follow.
OK, thank you very much indeed.
Pleasure.
That's Russ Mould. They're talking to us about the energy industry and oil.